All right, for this video, I wanted to cover IRS Revenue Procedure 8435. And this is a Rev Proc that can be used if you filed your partnership tax return late. So partnerships file an annual Form 1065. K1s, the Schedule K1s go along with the 1065, and these are issued to each owner of the partnership. Right, so the 1065s generally due on or before March 15th, right? That's if it's a calendar year partnership. You can always file an extension. They're automatic. You file it via Form 7004 if you need more time to file. But that is generally the due date. So if you file a partnership return late, the IRS assesses an automatic penalty using a predetermined formula. Now, it's also important to highlight that the filing penalty applies regardless of what kind of activity is going on in the entity. The partnership could have very little activity. It could have nothing but losses, right? So the partners aren't actually paying any income on the earnings because they're in a net loss position. That does not matter, right? The IRS will assess this penalty no matter whether you're profitable or in a loss position. So the penalty is fairly straightforward to calculate. It's $205 for each month or part of the month the return is late, up to a 12-month max, multiplying by the total number of partners during the year. Okay, so if you've got a partnership with a couple of partners in there and you filed it a few months late, this penalty can rack up pretty quickly, right? 205 times the number of months times the number of partners that are a partner of the entity during the tax year. Okay, so what are some of the options if you file late? Well, Rev Proc 8435 provides some relief for small partnerships that have only U.S. persons, right? And so if you can demonstrate that you meet these requirements, then the IRS will waive the penalty. So in order to meet the requirements in Rev Proc 8435, you need to meet the following conditions here. So first, the partnership has to be a small one, right? It can't have any more than 10 partners during the tax year. So if this is a large 50-partner partnership, this ain't going to work, okay? During the year, each partner had to be a natural person other than a non-resident alien or a natural person's estate, okay? So by natural person and not a non-resident alien, what they mean is it has to be a U.S. individual tax resident. So that's someone that's a U.S. citizen, a U.S. green card holder, or if you're in the U.S. Enough days during the year to meet the substantial presence test, you're a U.S. tax resident, you qualify. If you have any partners in there that are not natural persons, this will not work. So if you have a partnership with, let's say, one partner is a corporation, you're not going to meet these requirements, okay? So that's not going to be able to work. Now, the third element there is each partner's share of partnership items is the same as his proportionate share of any other partnership item. So what does that mean? It means you can't have any specially allocated items. And so where you would see this frequently is, let's say you have a private equity fund or a real estate fund, and there's a carried interest or some sort of performance fee allocation where the GP or one of the managing members is being allocated more money relative to their capital contribution to the company. That would be enough to torpedo this element. So you won't be able to use it if you have disproportionate allocations between certain types of income or expense. Fourth piece there is the partnership did not elect to be subject to the rules for consolidated audit proceedings, right? Those are the relevant code sections. And then lastly, all partners reported their income from the K1s on a timely filed Form 1040 tax return. Okay, so let's look at an example here. We have John, Mark, and Adam created Delaware LLC, taxed as a partnership. They are each U.S. citizens, and they live and work in Florida. All three partners filed extensions for their personal tax returns, but they forgot to extend the partnership return. So they filed their Form 1065 late by 2 months, and the IRS assessed a $1,200 penalty. Now, assuming the partnership meets all of these elements up here, they should be able to get a penalty waiver under this Rev Proc. Okay, so again, just to recap, these are smaller partnerships, less than 10 owners, no special allocations, no entities are partners, no non-resident persons are partners. It's just small partnerships with all U.S. owners, all U.S. individual owners, and each individual partner had to report all of their income on a timely filed 1040. And so that's important in this fact pattern. So John, Mark, and Adam, they extended their 1040s to October, so when they got their partnership return filed late, they got their K1s, they were still able to timely file their personal returns and report all this income. So that's also very important. Okay, so that covers it for this video and this slide. If you have any questions, please leave me a comment below, and I look forward to seeing you again soon. Thank you.